Hello and welcome to a CMS Forex daily video recap. I'm your fundamental market analyst, Nick Nassad. Today is Monday, June 21st, 2010. We started this week with some risk positive sentiment in that we had news that China would depeg the yuan from the dollar, ending a 2-year policy of holding the yuan steady put in place in 2008 as China had worried about its exports during the global recession. The news was taken as a sign that the global recovery was strong enough for China to pull a move like this, that the news helped to spur risk-on trades initially. While we look at the impact to the commodity currency pairs, first let's take a look at the euro-dollar. We see that following the open, we had gapped higher, reaching a high of 1.2466 and then retested that high prior to the open of European trading. However, during the rest of the European session, we paired those initial gains, tested our 50-period moving average at the 1.24 level, and then in New York trading dipped even lower, sliding below our low from Friday at the 1.2350 level. That also broke below an upward sloping line of support that we had seen throughout the rally that had lasted the last 2 weeks. So that was a pretty bearish sign for this pair. And the reason for it was a rating agency downgrade of a major European bank, which cast a shadow on investor sentiment. And that news was that Fitch downgraded the French banking giant BNP Parabas. Today's bearish action could mean that we will see a further retracement of this up move that we had seen over the past 2 weeks. If we plot a simple Fibonacci retracement, we see that the 23.8% retracement lines up nicely with the 200-period moving average, which is currently around the 1.2250 area, and we'll see if we come to test that low. That would be also the low that we had from Thursday's session. If the risk sentiment, the negative risk sentiment that we had seen in the New York session extends into the Asian session as well as tomorrow's European session. U.S. equities, which were up, or at least the Dow Jones, which is up triple digits, had paired all of its gains and actually closed the day in the red. So that was the story with our euro-dollar pair, and we see a rather similar development with the pound-dollar, which after rallying to start the session and hitting a new high at 1.4935, declined and paired all of its initial gains and then moved below the low we had set on Friday, and here we came close to testing the 200-period moving average in the 1-hour time frame. That was also a 61.8% retracement of our move from 1.4640, which we had seen on Thursday, to today's high. Turning to one of our commodity currencies, the US dollar Canadian dollar, we saw it move to a 1 month low as we moved below the 1.0150 level briefly to hit a low at 1.0137. However, around noontime, we did see the pair sharply reverse as oil prices gave up their loftier gains, and we had US equities give up their early gains as well. We pushed back above the 1.02 level and are settling the day at around 1.0240. That put us back above an important level at 1.0225, which we had pushed below in late Friday trading, and we had spent most of today's trading below that level. Now we do have a downward sloping level of resistance as well for the pair, and we'll see if we test that later on in today's or in the upcoming session. The fact that this resistance level that this old level of support didn't then turn to resistance could be an indication that we may not see a move towards parity just yet in this pair. Turning to the currency pair that may have the most to gain from the yuan appreciation would be the Australian dollar US dollar, as a stronger yuan would make Australian exports cheaper in China, which would stoke further demand for the country's exports such as iron and coal. The Aussie gapped about 90 pips higher to start today's trading and then moved even higher to 88.57 as its high in the early European session, but then as we did have risk sentiment deteriorate throughout the rest of the session, we paired those gains moving back down to the 0.8750 level. If we take a look at the Aussie US dollar, starting here back in early May at the 0.9320 level, and we plot a Fibonacci retracement down to our low around 0.81, we could see that in today's trading we moved above the 50% retracement of that downswing, but today's resistance came at the 61.8% level. The Aussie has been a really strong gainer since 0.81 as we had the sentiment around European sovereign debt risk calming somewhat, and we managed to push above the 0.85 level and then retest it as support and continue our rally until today's move to the 61.8% retracement here. Turning back to the story about China depegging its currency, what that means is that it will move back to a crawling peg in which the movements of the currency is still controlled by Chinese authorities. Still, a stronger yuan would help to curb inflation, a problem for the Chinese economy and its recovery, as inflation has accelerated to a 19-month high of 3.1% in May, higher than the government's full-year target of 3%. A higher yuan helps limit inflation by making imports cheaper. Also, it would lessen expectations of an interest rate increase from the central bank. A stronger yuan would also increase the consumer purchasing power of China and its households, which could accelerate a shift towards domestic demand becoming the prime driver of growth compared to export-led growth that China's economy is currently based on. That could help to address some of the imbalances, trade imbalances in the global economy, and the 5% rise in the yuan would shave about 1/5 of the U.S. trade deficit. A rebalancing of the global economy will be key in the upcoming G20 meeting at the end of this week, as China, as well as other countries such as Germany and Japan, are under increasing international pressure to spur domestic demand, while the U.S. needs to become a bit more thriftier. National leaders want to avoid a repeat of the last expansion, when U.S. consumers relied on borrowing to fund demand, which fanned an Asian export boom, and as China and others accumulated dollars from trade surpluses, they bought U.S. debt and depressed global yields. Those lower borrowing costs helped to stoke the U.S. housing and credit booms that turned to bust in 2007. Therefore, if China was to address its own economy and lower its savings rate while increasing consumption, it could mean that there would be less money flowing to finance debt in the U.S. Though if the U.S. would actually run a lower trade deficit, it would mean that it would need to actually sell less treasuries. But still, if China recycles fewer dollars, it could lead to higher borrowing costs. Now, this would be a gradual change, so currently we'll just see if perhaps this move by China is more of a political move prior to the G20 meeting coming up. So that will do it for today's fundamental as well as market highlights. So let's take a look at the upcoming fundamental docket. Overnight, Switzerland posts its trade balance, which will be followed by Germany's IFO Business Climate Index as well as the European current account. Tomorrow, Canada posts its consumer prices, when we also get the UK annual budget release, which will highlight the key spending cuts proposed by the new government. That's followed by a European consumer confidence report, as well as US existing home sales, a measure of housing prices, and the Richmond Fed Index. And that will conclude today's broadcast. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.